I was having lunch with a senior fund manager last week, the kind of veteran who spent the last decade comfortably betting on a hard landing for the Chinese economy. He was mid-sentence, leaning back with a glass of sparkling water, mocking the idea of the renminbi ever truly challenging the dollar. "It's a house of cards," he said, his voice full of that polished New York confidence. "It's a currency backed by ghost cities and state-mandated optimism. The real power stays where the debt is traded, not where the widgets are made." He looked completely at ease, almost bored by the historical predictability of it all. Then the 7.01 alert flashed on his phone, just a tiny, silent notification on the screen. The smirk didn't just fade, it evaporated. He didn't call his trading desk or check the news. He just stared at that number 7.01 with a look of genuine, quiet disorientation. In that moment, the air in the room seemed to get heavier. It wasn't the panic of a lost trade. It was the look of a man realizing the gravity of the earth had shifted while he was looking the other way. He had spent his entire career focused on the exorbitant privilege of the dollar and the magic of financial speculation, while seemingly forgetting about the literal millions of tons of steel, the sprawling automated ports, and the relentless industrial mass that actually gave that number its weight. What struck me wasn't the market move itself, but his sudden, total loss of a narrative. To him, 7.01 was a glitch in the matrix. But looking at his stunned expression, it became clear that we weren't just watching a currency fluctuation on a screen. We were witnessing a silent, seismic transfer of civilizational energy. That single decimal point represented the moment the world's financial ghost stories finally ran headfirst into a physical reality they could no longer explain away. A pivot from a world of printed promises to a world of things actually built.
That is, what a story. Because that image, that single moment of disorientation, it just perfectly captures the fundamental shift we're going to be talking about today.
Exactly. It felt profound.
For decades, the entire global financial system has operated on this assumption that currency power is somehow disconnected from physical reality, from things you can actually touch.
Right, from widgets and steel.
From widgets and steel. And today, we're seeing this huge structural transformation happening just beneath the surface of all the market volatility. So we really need to pivot our thinking, just like that fund manager was forced to do.
Right. We have to look away from the screens and look at what's actually being built.
Exactly. Away from pure financial speculation and toward recognizing the immovable weight of real-world productivity.
And that is really the mission for our deep dive today. We want to understand the tangible anchors, the real things that are driving this structural reallocation of global capital. We're going to be looking at how the renminbi's value is, increasingly rooted in stuff you can touch.
And things you can build with.
Yes, and in long-term strategic certainty. The core argument here really is that this whole shift of capital toward the renminbi is being driven by China's just unparalleled industrial capacity.
And its integrated supply chains.
Which together offer this tangible physical anchor for currency value. And that's in, stark contrast to these debt-heavy, deindustrialized financial systems that have defined the West for the last 50 years.
When we talk about a physical anchor, it's important to understand we're starting with sheer scale. I mean, this isn't some incremental lead we're talking about.
No.
It's an overwhelming industrial dominance that translates directly into economic weight and ultimately global leverage.
So let's start with the numbers, because this is where that old narrative, the House of Cards narrative, just immediately runs into trouble.
It really does.
When people talk about economic power, they often look at, financial sector size or nominal GDP. And that's useful, but it's an incomplete picture. The manufacturing data, that tells a much, much starker story about what the world actually produces.
A much more physical story. If you just look at global manufacturing output, China currently holds a massive 31.6% share.
31.6%.
Right. Now, you have to hold that number up against the United States, which, for all its immense economic power, accounts for 15.9%.
So just under 16%, which means China is producing almost exactly double the sheer volume of everything.
Double. Manufactured goods, inputs, components, finished products. This is the literal industrial mass we're talking about. The millions of tons of steel your fund manager friend was forgetting about. Right. This is what anchors economic strength in the long run.
That 31% isn't just a number on a spreadsheet, is it? It's a form of geopolitical leverage.
Absolutely.
When one country produces that much of the world's stuff, it basically controls supply chains, it dictates input costs, and, ultimately it builds a resilience that paper assets just can't replicate.
And that physical reality is what currency values, sooner or later, have to reflect. There's no escaping it.
And all of that manufacturing capacity, it has to feed something, right? It feeds this enormous export machine.
An export machine that is showing just remarkable resilience. I mean, think about it. Despite all the geopolitical friction, the tariffs, the protectionist policies you see popping up everywhere, China's export engine, it just remains formidable.
What are the projections looking like?
Well, we're seeing real exports on track for an estimated 8% growth in 2025. China's market share of global exports is already sitting around 15%.
15.
And all the projections suggest that this share will just continue its upward trajectory right through 2030.
Okay, but what's really crucial here, and I think a lot of people miss this, is where all that growth is coming from. Because if it were all just dependent on Western consumers, it would be vulnerable, right?
It would be incredibly vulnerable. But that is demonstrably not the case anymore.
So that's changed.
It's a critical structural point. If you want to understand the RMB's growing independence, you have to get this. Exports to the U.S. now represent less than 10% of China's total exports.
Less than 10%. Wow.
So this diversification, it means the industrial momentum is largely decoupled from the health and the policies of the U.S. market. The growth story now is fundamentally based on expanding trade with Asia, with Africa, Latin America, and other emerging markets.
And these are regions that are increasingly happy to trade and settle in renminbi.
They're more than happy. They're keen to do it.
So it's not just the volume of what's being made, it's also the strategic sophistication of what they are producing that gives them this edge even when global trade slows.
Exactly.
So what are the key drivers here? What's enabled them to build this kind of strategic lead?
The advantage is really rooted in this deliberate combination of scale, speed, and strategic state investment. The core drivers are pretty clear.
You play it out for us.
First, you have formidable and sustained cost advantages. These come from that massive scale we talked about and just incredibly efficient logistics. Second, a large and rapidly expanding STEM talent pool. The pipeline of engineers and researchers just dwarfs other nations. And third, and this is key, a state-driven push guided by a very clear national industrial policy into high-growth, high-value sectors.
Let's get specific on that. We hear generalities all the time, but what are the flagship sectors where China has just aggressively gone in and consolidated its lead, the places where they're essentially defining the future of that entire industry?
The best examples are in the sectors that are defining the energy transition and industrial automation. So we're talking about electric vehicle, or NEVs, new energy vehicles as they're often called.
Right.
The battery supply chain that powers them, robotics for advanced manufacturing, and of course, solar technology.
Yeah.
China didn't just decide to participate in these industries.
Yeah, the goal was domination.
The goal was to dominate them right from the start through vertical integration.
Can you explain that vertical integration piece, especially in the battery and EV space? Because it's a perfect illustration of this link between physical reality and strategic leverage.
It is. In the battery space, it's about controlling the entire value chain. I mean, from the very beginning, from the extraction and processing of the critical rare earth materials you need for battery cathodes.
Right, the stuff in the ground.
All the way through to final cell assembly. And then integrating those cells into the finished cars. The state-driven policy provided the initial, massive capital. Local subsidies created this huge domestic demand.
And the scale just built from there.
And the scale they achieved allowed costs to drop below any global competitor. So what does that mean in practice? It means that when a Western or an Asian car manufacturer needs batteries for their own EVs, they're often still reliant on a supply chain that runs straight through China.
Regardless of where their final assembly plant is.
It doesn't matter if the plant is in Germany or South Carolina. That reliance translates directly into economic leverage.
Which brings us back to this persistent idea of decoupling. We hear this word constantly. If this industrial ecosystem is so dominant, so vertically integrated, how real is the effort by global companies and governments to actually pull their production away?
Well, the ground reality is that decoupling remains more rhetoric than a practical, achievable reality for most of the world.
It's easier said than done.
Much easier.
Yeah.
While you do see some manufacturing processes shifting geographically, we see this in some Asian countries or maybe India, these new manufacturing hubs, they remain critically reliant on Chinese inputs and capital goods.
Can you elaborate on that? What exactly are these new factories still sourcing from China?
Well, they're dependent on the really high-end components, the specialized machinery, and often the initial capital investment you need to even set up a sophisticated factory. China has, in effect, become the world's factory for factories.
So even if you move, you're still buying from them.
Exactly. Let's say a company wants to move its textile production to Vietnam or electronics assembly to Mexico. They still need Chinese-made specialized weaving machines or specific molds or complex integrated circuits from a Chinese-backed supply chain to even run those new facilities.
So it just reinforces China's central indispensable role.
It does. The address on the box for final assembly might change, but the core intellectual and physical dependence on Chinese inputs, that remains completely intact.
That has to make the path just incredibly challenging for the traditional rivals, right? Like Japan and Korea, who always relied on their own sophisticated industrial bases. They must be getting squeezed.
They're absolutely losing ground. You can see it clear as day in the trade balances. Korea, for example, historically ran a strong trade surplus with China.
Right. They sold them high-end goods.
Exactly. But recently, that's flipped into a deficit, which signals a reliance on Chinese components now, rather than a competitive edge in finished goods. Japan's overall share of global exports is also sliding to historic lows.
And what about those ASEAN countries that are supposedly the beneficiaries of decoupling?
Well, while they might attract some new final assembly plants, their rising exports are consistently matched by sizable trade deficits with China. Why? Because they're buying the components and the capital goods they need to make those exports.
A closed loop.
It underscores a central truth. Most competing economies, they just lack the critical mass, the speed, and the state-backed resource mobilization to replicate China's comprehensive vertically integrated ecosystem. It's not possible at this point.
Okay, so we've established this industrial core, this foundation of physical weight. But now we come to a paradox, something that confuses people who rely on the old economic models.
Right.
If the industrial engine is so strong, outperforming everyone, racking up these huge trade surpluses, we're talking over $1 trillion year to date, why has the renminbi actually weakened a bit on a trade-weighted basis?
This is where we have to move away from thinking about pure market dynamics and start thinking about strategic governance.
So it's a choice.
It's a very deliberate choice. The renminbi's trajectory isn't a reflection of some fundamental weakness. It's a reflection of deliberate, heavy management by the People's Bank of China.
The PBOC.
The PBOC, yes. They're operating under what we can call a low-volatility FX framework. The number one focus is stability and maintaining a predictable, range-bound trajectory for the currency.
But why? Why would you intentionally manage the currency down or prevent it from appreciating when traditional economics says a massive trade surplus should push it sky high?
Because it's a strategic choice designed to maximize the longevity and the competitiveness of that industrial engine we just talked about.
So it's about protecting the golden goose.
Precisely. First, by keeping the renminbi steady or even slightly weaker, they make sure their exports stay globally competitive. That 31.6% manufacturing share is sensitive to currency price.
Okay, that makes sense.
Second, a stable currency helps them curb deflationary pressures at home, which ensures domestic investment stays robust. And finally, and this is crucial, the benefits of a much stronger yuan to Chinese consumers are seen as limited.
Why is that?
Because the country has a relatively low reliance on imported consumer goods. So they prioritize structural growth and industrial stability over, say, short-term gains in consumer purchasing power.
So they prefer to internationalize the currency through other means.
Through institutional means, yes. Not by just letting the market rip it higher.
That's a fascinating pivot. They're essentially telling the world our currency's value is dictated by our long-term plan for industrial dominance, not by your short-term financial flows.
That's it in a nutshell.
And that shifts our discussion perfectly from the physical anchor to what we could call the strategic anchor, the long-term policy certainty provided by the Chinese system itself.
And global institutional investors are increasingly making massive decisions based on this very certainty.
So they're betting on the system, not just the economy.
They are. When you compare the investment landscape, the long-term policy continuity, and the meritocratic structure of Chinese governance, it provides a strategic predictability that is just. It's not available in Western liberal democracies.
Which are prone to, volatile election cycles, legislative gridlock.
Abrupt policy U-turns every 4 to 8 years. That stability, that predictability is a massive and I think often underrated asset for capital that's looking for generational returns.
You're talking about the developmental state model. I think a lot of listeners might hear that term and think of, early 20th century state-led industrialization. But you're referring to something specific, a developmental state with Chinese characteristics. Can you define that model for us?
It's a unique model because it's so deeply rooted in its 3,000-year-old civilization and the ethical structure of traditional Confucianism.
So it's a much older, deeper-rooted philosophy of governance than, say, a modern Western model.
Much older. This heritage instills a fundamental cultural prioritization of stability, of order, and long-term national interest over, transient short-term political demands or electoral cycles. So the state model is therefore defined by this centralized, purposeful developmental intervention.
A commitment to continuous growth.
And strengthening overall national competitiveness, always with an eye on the long term.
This structure seems to be driven by planning horizons that they far exceed the 4 or 5 year cycles that dominate Western politics. We're always hearing about these 5-year plans. What is the true significance of these plans, especially given they've now had 14 of them since 1953?
That central planning is the absolute engine of the developmental state. Since 1953, the state has administered its development through this series of 14 5-year plans. And this framework, it's not just a suggestion.
It's a blueprint.
It's a blueprint that centrally directs investment, mobilizes resources, and sets very tangible goals across all industries, from building out infrastructure to making specific technological leaps. This ensures that growth is purposeful, coordinated, and always directed towards strategic national goals.
And it prevents resources from being wasted on, say, short-term market speculation.
Exactly. This coherence, this policy consistency, is extremely attractive to large-scale institutional capital, the kind of funds looking to deploy billions over a 20 or 30-year timeline.
But how does the institutional structure maintain that level of stability, especially with the immense size and complexity of the country? Isn't there a risk of, bureaucratic infighting or sudden inflexible policy shifts?
The key is the administrative balance that's been cultivated in Beijing. The system is specifically designed to make institutional progress less vulnerable to abrupt, factional, or inflexible policy swings.
So there's a coherence to it.
Despite the nation's scale, there is a coherent, unified approach that consistently prioritizes national development and the achievement of real physical outcomes over short-term political expediency. It's a kind of efficiency mechanism for governance itself.
And central to that efficiency has to be the quality of the people driving the strategy, this idea of meritocratic governance.
Precisely. The system aims for a meritocratic goal. It works to bring together all the critical interest groups, the state, major business sectors, society, to generate a consensus on these long-term strategic goals.
And who implements them?
They're implemented by well-educated, efficient, and deeply committed technocrats at the central core. And these people are selected and promoted based on proven administrative track records, particularly in managing complex economic projects at the local and provincial level.
So the state guides things, but it also uses the private sector.
It leverages private sector expertise when necessary. Absolutely. The state provides the strategic guidance, it fuels investment through controlled finance, and it oversees policy. But it's not ideologically rigid.
That focus on real, measurable outcomes seems to be the ultimate proof of the model's efficacy. It's a sharp contrast with systems that often prioritize rhetoric or short-term electoral gains.
That's the strategic difference right there. We can point to very clear policy successes that reflect this focus on tangible results. The most dramatic example, of course, is the campaign to lift nearly 100 million people out of poverty since 2012.
Which wasn't just, a byproduct of economic growth.
Not at all. That was a massive, centrally administered logistical and social undertaking that required unwavering commitment across multiple layers of government. And now, that strategic focus has shifted towards new, long-term objectives.
Like rural revitalization.
Rural revitalization and achieving common prosperity, which reflects an understanding that socioeconomic advancement has to be continuous and it has to be widely distributed.
So the state isn't just focused on maximizing GDP growth. It's fundamentally trying to manage the distribution and the longevity of that growth. It sees it as a continuous work in progress.
That's the Chinese brand of the developmental state. It offers a sophisticated, localized understanding of socioeconomic advancement that, contrasts with the often context-free, orthodox neoliberal models that dominated global thinking for decades. Institutionalized policy intervention remains a powerful force in managing the complexities of globalization and the financial instability that often comes with it. For long-term investors, that policy certainty from a state focused relentlessly on these defined multi-decade goals, it often outweighs the volatility and short-termism of other markets.
So we've covered the physical anchor, the industrial dominance, and the strategic anchor, the policy certainty. Now we have to move to the broadest and maybe the most profound concept underlying this whole transition, the civilizational pivot.
Right.
We're moving beyond just economics and governance here into a larger historical and cultural challenge to the existing world order.
This is absolutely essential for context. The strengthening of the renminbi, from this perspective, is viewed through a lens that's much wider than standard currency trading. It's seen as signifying a historical transition.
A pivot.
A pivot away from what is perceived as a declining Western financial hegemony and toward a revitalized Eastern civilization state, one that's rooted in real-world productivity and an enduring social order.
What exactly does that term civilization state convey in this context? Why is that self-perception so important for understanding the RMB's strategic rise?
A civilization state is a governing entity that sees itself not merely as a modern nation-state following some Western template,
but as the modern manifestation of a multi-millennial civilization.
Exactly. So its rapid rise and the success of its unique development model, one that often challenges Western assumptions about governance and liberal democracy, all of this is seen as proof of the inherent success and exceptionalism of its framework.
So the renminbi's rise is therefore imbued with this historical and civilizational momentum.
It's not just a temporary economic surge. It's seen as the natural reassertion of historical influence.
This momentum then must translate into a very deliberate staged strategy for RMB internationalization. What are the key phases that China has been focused on since the 2007-08 global financial crisis?
Well, currency internationalization is a multi-step process. Historically, you can break it down into three key stages. First, becoming a trading currency.
Meaning it's used for actual transactions.
Yes, as the medium of exchange or the vehicle currency for cross-border deals. Second, it becomes an investment currency. This is where private agents, corporations start holding liquid assets, bonds, equities, deposits denominated in that currency.
And the final stage.
The final stage is becoming an international reserve currency held by central banks around the world as part of their official foreign reserves. And China has been accelerating its efforts across all three of these stages, especially since the global financial crisis really exposed the volatility that was inherent in the dollar-dominated system.
To achieve these goals, especially the first two stages, China would need to build an entirely new, parallel financial infrastructure, one that can function independently of the existing dollar-dominated Western-controlled system.
They do, and they have been.
So what does this new architecture look like?
The foundational element of this new architecture is the launch of the Cross-Border Interbank Payment System, or CIPS, which went live back in 2015.
And this is a direct challenge to the legacy SWIFT system.
It is a deliberate structural challenge to SWIFT.
We hear the name CIPS a lot, but can you break down how it actually works and why its functionality is so critical for this internationalization effort?
So CIPS is designed to be the central clearinghouse for all renminbi payments globally. Its most crucial function is providing direct access to the China National Advanced Payment System. By doing that, it significantly reduces the reliance on traditional correspondent banks,
which are often U.S. or European.
Right. And it reduces the reliance on the complex payment pathways that inevitably involve passing through the U.S. dollar system for settlement.
So just to make it practical, if a Brazilian company wants to pay a Chinese firm for some goods using RMB, CIPS lets them do that directly, RMB for RMB, without ever needing a U.S. bank or being subject to U.S. jurisdiction.
That is precisely it. It mitigates sanctions risk and it speeds up transactions. And what's more, CIPS's payment messages are written in both English and Chinese, which eliminates translation issues, and it uses globally accepted messaging standards. So it's easy for offshore banks to process.
It essentially enables direct RMB settlement offshore.
And in doing so, it severs the financial umbilical cord to the New York clearing system.
Now, alongside CIPS, China has also been strategically expanding its network of bilateral currency swap arrangements, or BSAs. The data from 2016 showed 36 of these were established. How do these arrangements help?
The BSAs are agreements between central banks. They allow them to swap their respective currencies up to a pre-agreed limit. And the new Chinese arrangements are vastly larger than older bilateral agreements, sometimes 10 times the previous size.
And what's their purpose?
They're specifically structured to facilitate RMB settlement in bilateral trade and direct investment, So if an emerging market partner suddenly needs RMB liquidity for trade, they can access it directly through the swap line.
Bypassing the need to go buy US dollars on the open market first.
Exactly. It actively pushes the renminbi into a functional international role as a direct medium of exchange.
And to make the currency fully accessible, in all time zones, they've also established this physical web of financial outposts.
That's right. They've built up a global web of RMB clearing centers in major financial hubs: London, Frankfurt, Singapore.
Yeah.
And soon, New York is expected to join that list.
And these centers, plus the move to direct trading of the yuan against the euro and the pound.
It all makes the RMB more attractive and more functional for foreign customers and financial institutions, no matter where they are. It normalizes its use as a major trading instrument.
So we're moving beyond the currency plumbing now. This pivot also involves a kind of institutional restructuring that directly complements and also challenges the post-war Western-led institutions.
Yes. Here we're talking about the Asian Infrastructure Investment Bank, the AIIB, and the BRICS New Development Bank, or NDB.
And these new multilateral development banks, they're a critical piece of this civilizational shift, aren't they?
They're a critical component. They're positioned as necessary complements to and potential reformers of Western-led institutions like the World Bank and the IMF. They represent a strategic effort to offer developing nations alternative sources of capital and different governance models.
Let's focus on the AIIB. What's its specific mandate, and why has it become so influential so quickly?
The AIIB's primary role is to harness China's vast financial resources, its tech capabilities, and its immense infrastructure expertise to fund massive projects across Asia. It focuses on critical areas like energy, sanitation, transportation, logistics.
Things people actually need.
Tangible development.
Yeah.
It reflects this evolving global economic landscape. And the stated goal from the Chinese leadership is to make global economic governance more just and equitable. They do that by addressing genuine infrastructure gaps that Western-led institutions have sometimes been too slow to fund or have overlooked.
And the fact that major U.S. allies, Britain, Germany, France, they all joined the AIIB despite really overt lobbying from the U.S. government not to, that's a pretty powerful indicator of its legitimacy, isn't it?
It speaks volumes. Institutional power is key to achieving reserve currency status. The AIIB acts as this catalyst for investment. It enables emerging powers to divert resources away from IMF dependence, and in doing so, it builds genuine institutional power for the renminbi. The speed and focus of AIIB lending, which often prioritizes these physical projects, is highly attractive to nations seeking tangible development outcomes.
Okay, the final practical illustration of this whole institutional pivot is the active policy of dollar deleverage. This means China has to actively manage its massive foreign reserves, which are recorded at a staggering, $3.2 trillion.
That's right. And this dollar deleveraging policy is a critical strategic move. It's driven by a dual purpose.
What's the first one?
First, they have to manage the domestic inflation pressure that comes with holding such enormous foreign reserves. If you don't deploy it properly, it risks overheating your domestic economy.
And the second, more strategic purpose.
It supports their comprehensive Go Global strategy.
And how does the Go Global strategy connect with selling off dollar assets?
The Go Global strategy is all about helping key Chinese firms, especially those in high-tech and strategic infrastructure sectors, to expand into overseas markets through outward direct investment, or ODI.
So they use the reserves to fund buyouts and new projects abroad.
Exactly. By using its foreign reserves to fund these ODI activities, China can achieve several goals at once. It facilitates the acquisition of advanced technology, it increases the global market share for its national champions, and, crucially, it reduces its overall reliance on dollar-denominated assets.
Particularly low-yielding U.S. Treasury debt.
Right. It's a way to turn what are essentially stagnant reserves into active strategic assets.
Do we have hard evidence of this deleveraging in action, or is it still mostly theoretical?
Oh, we absolutely have concrete data. A really powerful illustration came in 2015 when China sold a record $510 billion in foreign exchange reserves in a single year.
$510 billion.
And the majority of that involved actively selling U.S. Treasury debt. We're talking an estimated $292 billion worth, along with sales of U.S. stocks and other non-U.S. assets. This aggressive asset sale is the practical, physical illustration of that policy in motion.
It's a direct reduction of their dollar holdings.
And a clear signal of a structural shift in their reserve management strategy, moving away from the centrality of the dollar. So if we bring all these layers together, you've got the commanding industrial base providing the physical weight,
Right, the foundation.
a long-term policy certainty offering the strategic stability, and the active construction of a parallel institutional and payment architecture.
You can see the whole picture.
You can see that the global narrative of predictable financial speculation is, well, it's fundamentally dissolving. It's being replaced by a recognition that true currency power is increasingly rooted in tangible industrial reality, in unwavering state capacity, and in the diligent creation of alternative global institutions.
The shift toward the renminbi is a silent, seismic transfer of global energy.
It is. The growing strength of the renminbi is the ultimate reflection of a civilization state that is intensely focused on real-world productivity and enduring social order. It's that moment your fund manager friend had. It's the moment the world's financial expectations run headfirst into the physical reality of what has actually been built.
That structural reality, the sheer volume of steel, the integrated supply chains, and the strategic certainty of its governance, that is what gives this currency its weight, making the whole idea of a financial house of cards completely irrelevant. The pivot from printed promises to physical things built is a profound transition, and it's fundamentally restructuring global capital as we speak.